Welcome to the business proposal. Let's get started. We'll talk first about some background information about me. We'll then move on to the business fundamentals, the business outlook, the actual proposal itself, some highlights on the financials, and lastly, why you should invest. Background information. I was looking for a business where you can make money without having a direct correlation with time spent. Essentially, a business that did not require a lot of time and I could spend a small amount of time or maintenance hours in order to keep it running for me. I went ahead and settled on vending machines. In 2021, I bought a existing business and saw that during COVID-19, the sales were stable and throughout the years, they were consistently able to increase their revenue, time over time. Since then, I've added more machines and been reinvesting into the business. So now we're looking to expand. Things that we work on are location, quality machines, service, and diversifying our income. In terms of location actually determines how much money you'll make. The better the location, the better the sales. The better machines you have also play a role. You see, if the machines are not working, you don't make sales. If the machines are not up to standards, most people won't use them. And if the machines continuously break, that means more time and money going towards fixing them rather than making money. And this also affects our service. We want to give a high service. You see, with the larger bottlers like Coca-Cola and Pepsi, they have so many moving parts, it's hard for them to actually provide the service that many customers are wanting. And so when we're able to provide a higher quality of service, we're able to ensure that we're not going to be asked to leave the location, right? And then lastly, diversifying our income. We do have a few things down the pipeline in terms of adding more sources of income using vending machines. Excellence comes when we balance quality with quantity. This is a quote from Amit Ray. And I really do like it because it really does define vending machines quite well. You can have 1,000 machines that are all making $100, or you can have one machine that's making the same amount of money. But the really key excellence here is being able to have a large quantity of quality machines, right? And that's really when you've hit excellence. So just to go back, we started in 2021. We saw it was stable during the pandemic. We started with 12 machines in 11 locations. We had grown to 32 machines in 31 locations. We maintain and service our own machines. So in terms of servicing, we don't hire anybody. In terms of any repairs, what we personally can't do, we have a technician that does for us, and now we're looking to grow even faster. Business fundamentals. I'm sure many of you guys know what a vending machine is. I'm sure you guys have seen vending machines, and usually you probably have seen the snack and food and beverages. That is the majority of what gets vended. But there are other specialty items like electronics you probably see in airports, hygiene products that you've seen in hotel and motels, and more. Essentially, a vending machine can vend whatever you really want it to, right? The main key of having a vending machine is like having an employee, right? This employee validates your payment, makes sure that the tender is correct, and even the newer vending machines have drop sensors to ensure the customer received what they paid for. And if not, it'll continue to try, and if they still can't give it to the customer, it'll let them buy something else. Your end of the deal is to ensure the machine is full so it can sell those items. Quite often we're asked, how much do we make on our products? How do you decide what is profitable? And can the demand last, right? Again, this is one of those businesses people don't really think about, but that's okay. We'll go ahead and explain it. We'll explain it a little bit more. Chips. You're able to buy 30 bags for $18.48. Each bag is 62 cents. So if you're selling a bag for $1.25, and just as well, heads up, this $1.25 is not a random number. It is what we're actually selling these bags for. Your gross profit is 63 cents. That's a 50% return on your sales price or 101% ROI. Well, let's move on to some other items. Pastries, 56% returns on your sale price or 127% ROI. Donuts, again, as you can see, we're above that 50% mark in terms of sales and 115% on your ROI. What about soda? 48 to 61% depending on where you're buying it from, and then 92 to 156% on your ROI. So as you can see, we do have a high percentage. Sure, everything's in cents, but nonetheless, it's a pretty high percentage. So our general pricing guide essentially is this. We want to buy wholesale because when you say pennies, they translate to dollars further down the line. If you're buying a can for 60 cents instead of 65 cents, that's only 5 cents. But if you multiply it with the amount that we're buying each month and then for each year, that does translate quite often. And then the second thing we want to do is price it for at least double. We keep our prices to where we're able to ensure there is still demand, right? People don't want to overpay for things, and if it's a bit too high, no one's going to pay for it. But even then, we at least have that general 50% double of what you're going for, minimum. And sometimes we're able to price it a bit higher. Lastly, is really it's a high volume, low price kind of business. We rely on our high volume, and that's what we make our money on. Let's break down the profit. So on a dollar, right, every dollar that we're earning, 50% of that goes towards our product cost. 10% is about operational costs. Again, depends on how well efficient you are, how many vending machines you have, if they're newer, if they're not, right? Things like this. And then lastly, that 40% becomes your profit before any taxes or salaries. And the standard for our industry is about 30% or more. So we're doing quite well. Let's take a look at our business outlook. Next question usually is, well, where do you place your machines, right? Well, manufacturing, offices, hotels, and schools are usually where most vending machines are placed. Schools, you need to put in a bid. Once you win the bid, you're able to bid for more locations, and there are regulations to follow. But nonetheless, according to this 2019 report, you can see a majority of the time it's manufacturing or offices that tend to have more vending machines. And it would make sense because you want to have a place with large foot traffic, right? Because if enough people are walking by, enough people will stop by, and enough people will actually buy. You have a loyal or regular clientele. If you have a manufacturing plant that has 1,000 employees, those people are clocking in and day out. They're working up sweat. They're getting exhausted. They're going to continue to buy from you as long as you take care of them. The place needs to have food, right? They have a need for food. If you're putting it inside a pizza spot, they're already selling pizza. You're not going to make any sales. And then lastly, there has to be space for the vending machine. But there are other things that go in terms of figuring out what is more profitable, right? If you're trying to find profitability, there's more calculations toward it. But nonetheless, as a general idea, you want to put it in places where a vending machine will be needed. How much can somebody make? As again, we said, it's dependent on location. That's literally the huge determining factor for sales. As you can see across the US, though, many people have reported making anywhere from $75 a machine to $500 a machine. It's about $2 to $16 a day. On average, though, most people are making $300. But as you can see, there's vendors with more machines making less per machine than other vendors. And so, again, location really makes that huge difference. It's not the number of machines, but yes, if you hit a number of machines, eventually you'll bring in enough money that you'd like to make. Other factors that are like credit card capability, the machine type, things you provide, how easy it is to contact you, how well you market your machines, do have an effect on sales as well. But again, those are secondary where the primary is location. And can the demand last? I mean, that's one of the biggest things. When you look at a business that you're not aware of, almost every time you're wondering, can it really stay as busy as people say it will be? And if you look at it, actually, 67% of operators are really people that are making $1 million or less. I mean, less than $1 million is the majority of operators. Usually, when you think of vending machines, you're thinking about Coca-Cola and Pepsi. But the reality is they have so many things going on that they have slim profits. So it's really better suited for smaller operators. And the global market really is growing. It has a CAGR of 10.7% from 2022 to 2030, and it's expected to grow from 134 billion in 2019 to 146 billion by 2027. Right? In the nation, over 2 million machines are owned by small businesses. So the reality is it's growing, and there's a need for vending machines. There's no less need for vending machines, if that's easier to understand. Let's take a look at Lori and Barry Strickland. We'll talk about their story and things that they've understood from the vending machine business. In 1989, in San Diego, a high school teacher, Barry Strickland, bought 5 machines as a way to make extra money and avoid teaching summer school. By the time they sold their route, they had 250 vending machines in the San Diego area and had gross sales more than 500,000 a year. Now they renovate old machines and teach entrepreneurs about the vending machine business, and they saw that the number of students had doubled in 2020. Even during the COVID time, people were interested, but they understood that vending machines are recession proof. And they know they've been in the businesses since 1989. When it comes to the business itself, though, Barry says it's pretty bread and butter. They make a gross sales about 4,000 to $6,000 a year per machine, and with roughly 40% of that being profit, you can do much better, as he says. You build up routes and you try to stay as efficient as possible to grow your business. They understand that a lot of times with people getting their first locations, they're having trouble, but they really do recommend blue collar businesses, around 100 people or so, if not more, where they do physical labor, or places such as nursing homes where people want to kill time. Overall, though, they understand vending machines really haven't changed since 1989. Only thing is, technology has been added so they can follow inventory and buying data in real time. Now, let's take a quick look at the proposal that we're proposing. We're going for a cost plus financing method. This is an Islamic method where the buyer and seller agree to the cost of and a markup of an asset. We'll go ahead and take a quick look at this video and be right back.
Someone asks you how trade-based financing works in an Islamic bank. Can you explain? Let us understand through the story of Ahmed. Ahmed, a toy dealer, needs to purchase a new stock of toys for his business. Unfortunately, he cannot afford to purchase his new stock at an outright price due to lack of funds. Knowing the ruling that God has permitted trade and forbidden interest, and having heard about how Islamic banking supports businesses on trading-based structures, he decides to approach an Islamic bank to finance his purchases. Ahmed explains to the banking officer that he needs to purchase 10,000 units of a toy item from ABC company for 100 rupees each. Understanding Ahmed's needs, the banking officer recommends a Murabaha-based financing solution. Simply put, Murabaha is a trade transaction between a buyer and a seller, involving the sale of a commodity with the cost of goods and profit known to both parties. So, how does Murabaha work in a banking context? The officer goes on to explain that the bank will initially undertake the role of the buyer and purchase the stock of toys from ABC company as per Ahmed's requirements, along with Ahmed's consent that he will purchase the same stock from the bank with a profit of 5 rupees on each item. An agent may be appointed by the bank to carry out this purchase transaction on behalf of the bank with the supplier. In this case, Ahmed would be appointed as the agent. Having purchased the stock and taken the risk of ownership, the bank will now take the role of the seller and will sell each toy to Ahmed at 105 rupees, as per his initial agreement to purchase the stock of toys. He also undertakes to pay for the goods either on an installment basis or as a one-off payment on a pre-agreed future date. Now, the relationship between Ahmed and the bank is that of a buyer and seller, whereby the ownership along with the risk and reward is now transferred to Ahmed upon close of the sale. So how is this different to a conventional loan? The key difference lies in the contract structure. Murabaha is a sale contract, while the conventional loan is an interest-based lending agreement. Unlike a conventional loan, a facility under the Murabaha-based sales structure does not permit the Islamic bank to profit from charging late payment fees or burdening customers with other snowballing interest upon interest charges, as the selling price has already been agreed. In summary, Murabaha is a sale-based transaction. The relationship between the customer and the bank is that of a buyer and seller. The bank initially purchases the goods the customer requires and sells them to the customer with a profit, which is disclosed to the customer in advance. At one point of time, the ownership of the goods and all associated risks are borne by the bank. The customer can pay the bank on an installment basis within an agreed period or as a one-off payment at a pre-agreed future date. The bank cannot profit from any late payment fees. Now that Ahmed was convinced he is looking forward for more Murabaha-based financing for other stock items he retails at his toy store, he also recommended the same Murabaha solution to a friend who wanted to purchase a personal laptop but did not have enough money to buy it outright. Similar to Ahmed, you too can benefit from Murabaha to finance your business as well as personal purchases such as furniture, electronics, household appliances, and much more. So now that you know, the next time someone asks you how trade-based financing, or in other words, Murabaha works, you can enlighten them. Amana Bank. It's your bank.
Welcome back. Let's move forward. So when it comes to the seller, the investors will be buying the asset, which is the business assets. In this case, the vending machines, parts, any inventory, business assets, things like that, right? Directly from the seller at their asking price, and this price will be negotiated by the buyer. Then the investors will now own the assets of this business. So in this case, again, the vending machines and any other assets that are sold to them. When it comes to the investors, they'll go ahead and sell the asset, in this case, the business assets, to the buyer, which will be me, at a higher price than it was bought for. So this price now includes a markup on top of the capital invested. And they'll be receiving that payment through a payment plan. Now, failure for the buyer to maintain these payments leave the investors the ability to take control of their assets once again. So for people that are concerned, if you're not able to pay us back, what will happen? And that's a general concern that anybody who's investing should be concerned about. Essentially, it's not that you've lost your money and it's all down the drain. You keep the payments that have been paid to you by me already, and you take back the business. Now we have the ability to renegotiate if that's something you're up to doing, or you can completely sell it in the free market, whatever you choose to do. Now, as a buyer, my responsibility is to make sure the investors are paid monthly as per the sale and payment plan conditions. And again, this is the sale price that includes your capital plus a profit. This way, it does not involve any interest. Again, you're not loaning me money to buy a business. You are loaning nothing. You are buying a business and selling it. That is your only difference. Now, failure for maintaining payment again means you can reclaim the business assets. And so you guys, if I were to break it down, are essentially providing startup capital that you get a profit on and not buying a portion or a percentage of the company. So you're able to provide startup capital, receive money back on it without interest. That's one of the biggest things to understand from the structure. Now you're probably wondering, well, what is the markup? Markup's going to be 50%. So in this scenario, if you had bought the vending machine business for 200,000, you will sell it to me at 300,000. And this 50% markup is set. So if you negotiate to be lower, it's not going to be a higher markup. It's going to be the same 50% markup no matter what. Let's look at the payment plan. So when the route is actually bought from the sellers, the investors will spend their $200,000 or less. And during this time, I'll negotiate on behalf of the investors. When the investors sell to the buyer, the investors will make a 6-year payment plan with that 50% markup. Again, no matter what the price, we'll do 6 years, 50% markup. The buyer will sign the contract to fulfill the obligation. Then, investors give the buyer 3 months. During this 3 months, no payments are paid to the investors. Investors have nothing to do at this time, they're just patiently waiting. As a buyer, I ensure there's a smooth transition between the old owners and the new owners, and I ensure that there's enough reserves built financially that we can ensure that we'll pay off our investors and have cash on the side in case an emergency happens. Next 72 months or the 6 years, investors receive their money each month consistently, and the buyer will just pay them. When it comes to the taxes, again, each party is responsible for their own tax preparation and payments. Each has their own tax burdens. Again, we can discuss that if necessary, but essentially taxes are going to be for each party to figure out, but we will go ahead and communicate as necessary. Lastly, it's a long-term investment. That's what it really is. The investors and buyers understand that. The investors can't expect that in year 3 they get all their money back because something came up. Unfortunately, the way the deal is structured, it's not going to be possible to do that. And then again, as a buyer, I understand I have to pay you back no matter what. So if there was a time where, we got an offer on the business that is, and that we're unable to say no to, right? We got to pay you guys off first at the time of sale. But nonetheless, there is no promise of early repayment or anything like that. We're going to stick to the schedule. And if we're able to pay early, then great. And if not, then it's understood that there's just going to be that time period. So we're going to go over three examples of like different sale prices for further clarification. So if the investors bought the business for 200,000, they'll sell for 300. We'll go over the financials on that. If the investors buy for 150 and they sell it for 225, we'll go over that. And then lastly, if they buy for 100 and sell for 150, as you can see, each of these examples have a 50% markup, but by no means are we going to be selling it specifically at these prices. Just again, that's for further clarification. So let's say you were able to sell it to me at 300,000 for each year during those each 6 years. About $50,000 will be paid back to you guys. So it's going to be about $4,166.66 for 71 months and $4,167.14 for 1 month, right? This is a 7% annual return. If you were to break it down between investors, if you had one investor, two investors, three investors, or four, you'll see that each investor would have a different amount they have to invest. With one investor, it's the full 200,000, and they'll receive $4,000 a month. With two investors, they'll each invest 100,000 and each be receiving $2,000 each month. And three investors, each will be investing 67,000 and each will be roughly receiving 1.3 thousand a month. And then lastly, if there were four investors, each investor invests $50,000, and each will receive $1,000 a month repayment. If we had a $225,000 sale price, you'll see how it's broken down again between one to four investors, and again, it's a 7% annualized return on your money. Nonetheless, you will see that each person will be paid in accordance to the repayment plan. But again, if there was just one investor, they'd be receiving $3,125 for 72 months. And lastly, at $150,000 sale price, again, each year for 6 years, we'll be receiving 25,000. And again, if it's broken into more investors, each will be receiving their fair share. So this is assuming each investor paid the same amount. But again, by no means does it necessarily mean each investor has to pay the same. If an investor wants to pay more than welcome. But nonetheless, it'll all depend on our final price. But as you can see, the lower the price and the more investors you have, if you're only investing $25,000, it's going to take a while before you receive that plus 50% over 6 years. So for that reason, we're asking that each investor has to invest a minimum $50,000, and the investment does not necessarily have to be 50,000 each or 75,000 each. It can be broken down to different amounts. Nonetheless, minimum $50,000. Now, if more capital is raised than what's needed, so if they raise that $200,000, negotiate, and they sell at 125, and that will mean that some investor or investors might receive their capital back simply because we can't use it. And if we do, that would become a loan, right? And we're not trying to do a loan. So that's the difference here. We'll go over some financials now about the company. As you see, it's 22 locations, 15 have been since 2013, 50 machines. Now, 41 machines they own full and clear, 9 machines they actually lease with the large bottlers. And the way that lease actually works is this. They don't pay for the machine, they don't pay monthly or anything like that. These bottlers will give you a free machine to take care of. But where they do make their money on is you have a agreement to buy a certain amount of cases of drinks through these bottlers. And as you can imagine, it comes with a markup. Nonetheless, it's still not a bad deal because they take care of vending machines for you. So if there's any problem on your vending machines, they'll come and service it and whatnot. As you can see, the last 5 years of COGS are essentially 50%. Of course, 2020, during a pandemic, it went up by 4%, so really not that bad, but went right back down. In the last 5 years of sales, you'll see same thing. 2020 pandemic, it went down, but it actually was above their 2018 mark. So it was still above what they made in it was very close to what they made in 2018. It went below, but very close. In 2021, it bounced right back up, only a few $1,000s less than what they were last year in 2019. So 13 locations do have service agreements in place, and you'd imagine there'd be more, but in this industry, a lot of the times you'll get a location because you don't have a service agreement. And then there are 11 locations that are at 24/7 places. That makes it much more flexible and you're able to service at any time. So let's go into the COGS a bit more. So you'll see specifically what they spent in 2017 through 2021, and you'll see the percentages on that. And in terms of sales, again, they're selling 22 locations to us. At one point in time, they did have more locations, and you'll see that sales data here in a second. But if you're looking throughout here, you'll see locations 8, 10, 20, 20 and 21 weren't acquired until later on throughout those years. But nonetheless, each location has been doing pretty well. Of course, location 1 through location 4 are doing pretty well and doing majority of the work. Location 1 especially bringing in $40,000 a year, with the top 7 bringing in about 10,000 or more, and then locations 8 through 22, they have a decent amount of money bringing in, but not as much as we'd like to see. Hopefully we can work on increasing that, but nonetheless you can see how we're looking in on sales specifically for each machine. And again, each location has a different number of machines and type of machines. Now, again, what we mentioned, if you are given the sales data, you'll see that they also have other locations that are sold or discontinued. So we went ahead and added those up separately, and you'd see that 141,000 becomes 165, 165 becomes 190, so on and so forth. But nonetheless, as the years continue, you'll see that they did sell out or discontinued most of their locations. So their sales data is pretty accurate. And their COGS are based on essentially whatever was bought throughout those years. So the COGS are actually a little bit higher than in relation to what the numbers we're looking at specifically for location 1 to 22, but it's based off the actual total sales. So the 84,000 is based out that 165, the 95,000 on the 190, the 100,000 on the 198. So it's just a percentage. So realistically, it'd still be the same percentage even at lower sales. But again, just kind of looking at their sales data generally. For 2022, the expected sales is $200,000. So at a 40% profit rate, you're looking at 80,000. 30% you're looking at 60,000, and again, COGS are about 50%. So assuming you have operations between 10 to 20%, this is what you're looking at. So if you were to actually pull up that sales data again and put it in and look for specifically the profits, so if you look up here, profits for location 1 to 22 at 40% and 30%. Other than the years 2017 and 2018, you're almost always, 2017, 18, and 2020, you're almost always above 50,000, right? And at the highest peak price that they're asking, 200,000 at the moment, $50,000 repayment is doable. But again, you have to realize you also have another business that can take care of any deficiencies. And at a 30%, I mean that's really when you're hitting 50,000. If for 40%, what we're expecting to be, you're going to be more around that 56,000, 60,000, $70,000 area. Worst case scenario, if you go back to the 2017 numbers, when they're still growing the business, because again they had this business in 2013 when they first acquired it and grew it from there. It's continually growing each year, right? So nonetheless, let's take a quick look. Are we able to cover our expenses? And in this case, after all expenses are paid, what we're left with, well, the $300,000 sale price, again, 50,000 is kind of close to what I would like it to be, but any deficiencies can be covered. At 225,000 and 150,000, the payments are very much doable, right? After we're left with our operational costs taken out, we have enough profits to pay everybody off. What about labor, right? I mean, that's one of those bigger things to talk about. Is eventually, we'd like to have people and whatnot, and if you want to grow at a certain point, you're limited by the amount of labor you're able to give, right? But let's take a look at what labor actually would be for something like this. Nationwide, you're looking at about $16 an hour, but you also got to realize that in Lenexa, it's 1750, right? Because that's where we live. We'll kind of look in that area. 1750 for somebody working full time Monday through Friday. But the current owner themselves does not hire anybody. They actually run the business themselves. So we're going to be taking the same approach, and we'll be running the business at least for the 6 years by ourselves. And then afterwards, if we find it necessary, we'll hire somebody, or we'll go ahead and hire somebody and find a way to take care of that. But if we were to hire somebody, it's going to cost us 36,400 just in their salary. There are other costs when hiring employees, when it comes to their taxes, when it comes to the health benefits, and other miscellaneous costs when having an employee, especially sick time and whatnot. So for that reason, right now it's out of budget. We'll just go ahead and continue to take care of the business ourselves. Now there are two paths after we acquire this business. We either stay stable or we grow. With stability, even if prices go up, we're able to raise our prices as necessary. And with being stable, it allows us just continue to grow our cash reserves and invest into more safer things when required. Whereas with growth, once we're done paying everybody, we can add more locations. And we mentioned, with locations, you can make anywhere from $4,000 to $20,000 in revenue with a couple locations added. So as you saw in real-time sales data, that majority are at least $5,000 or more in sales. So if you're adding 2 machines, 3 machines, 4 machines, 5 machines, that can easily become that $4,000 to $20,000 range in revenue. More revenue means more profits. So we're able to also expand into other full line vending. So these are just vending machines, but many locations require other vending, like coffee vending, where you go visit every month to 3 months and give them the coffee beans or filters or anything like that. There's also water delivery, the 5 gallon water delivery. So, I mean, there are other things we can kind of expand into when looking into vending. And then lastly, there are other things that we can always invest our money into and have other expansions that we're talking about, like the digital signage, because we do have those locations. So, again, those are really the two things that we can do. For now, we'll have to see how the business grows and whether we want to grow it, whether we want to stay stable. Again, though, those are really the two paths. Nonetheless, either way, whether we want to grow or stay stable, we're always going to be able to pay our investors first. And that's one of the biggest things. So, lastly, it's why should you be investing, right? I mean, that's when it comes down to it, you're seeing that, hey, I can go ahead and pay my investors back. You see it's a stable business. You see that you can make your money, but you're like, why should I invest? Simply put it, a stable business with low risk, you have a low involvement, and you're getting high returns considering the market. Secondarily, it's a halal return for both parties, and you get your full money back within 6 years. So that's one of the bigger things. A lot of the times we're concerned with whether we're investing into the market or into a business or into something is, are we really, getting our money's worth? And is it really something we're able to keep? One of the concerns is, are they investing into the wrong things? You want to invest in a gas station, they don't make their money unless there's lottery and alcohol and whatnot. So this is one of those businesses that there's no concerns about the promiscuity of the business. There's no issues with what the business is doing, and your money's being returned well. And again, talking about the markets, the S&P over the last year is down 20%, right? If you look at the Dow Jones, it's down 9%. And knowing today's conditions, especially with a recession coming up, you can see we are concerned about the recession, right? Any money invested will either be going further down or will stay flat for the next year or two until the economy is able to recover. And one of the biggest things is if you want to invest your money somewhere, it's really hard to, especially with real estate going here and there. So the point is, when it comes to recessions, people really don't consider the price of chips and vending machines. They'll go ahead and lower their costs other places, but they usually don't lower too much when it comes to vending machines. Of course, our personal habits are a bit different than the average, consumer. That's one of the biggest things to kind of take your mind off is when it comes to vending machines, especially, you may not be using them. I may not be using them, but at the end of the day, there are other people using it and they're willing to still spend their dollar, their last dollar in a vending machine. So at the end of the day, you're interested and you're like, well, what do we do? Right? You're like, what's next? We saw that you're able to pay us back. It's a stable business, it's a strong business, it's a boring business, but it's a business that we know that is making money and can pay us back. Well, we'll go ahead and collect funds in escrow. We'll have a lawyer draft contracts between the sellers, the investors, and the buyers all separately. We'll go ahead and have me as the buyer negotiate the price. We'll go ahead and have the investors pay the sellers, and then we'll initiate that contract between the investors and the buyer. And then from there, the buyer will just keep paying the investors. So from there on, you will just be paid as according to the contract. So I appreciate you taking your time to hear me out. Hopefully, the process makes sense. If there's any questions, concerns, please feel free to reach out and we can discuss those any further and we'll go from there. Have a good day. Thank you. Bye bye.